Okay, so this is chapter 13 that we're working on right now. Okay, so again, as I said in the other videos, the way that I do this is I print out the assignment, I do it, and now I'm talking about it. Unfortunately, the order that I get the questions in is most likely different than the order that we're going to be talking about them. So that means you will have to hear me flipping through the pages so that I can see my notes and see what I answered so that I can talk about it. Okay, so let's start. Which of the following is not correct with respect to ASC 842? Okay. Okay, so for this one here, this is largely definitional question. Um, so when we think about ASC 842, um, it's basically um, ASC 842 really was a large change from what previously existed under GAAP. So the correct option is this, I believe. Um, it, um, sorry, the not correct option is this, which then makes it correct. Um, the idea here was that you would have some transition between 840 under GAAP and ASC 842. So if they had um, not been if they had been not similar, it would have been difficult to do any comparisons over time during that transition. So um, again, just to clear up any confusion here, the development of ASC 842 did I mean it was an update to the policy, but it did not it was not significant enough, or it wasn't such an altered change that you couldn't compare what was done under 840 compared to what was done under ASC 842. Okay, let's go to the next one. And then going back to 842, again, 842 is very important throughout this entire chapter because that is kind of what's guiding us in terms of leases. Consistent with ASC 842, if a company sells an asset for a profit of 175K and then immediately leases it back, how do we recognize that gain? So here, what we see under 842 is that the gains are typically recognized right away when you're leasing it back. So we know that it would be immediately as an ordinary gain, which is really the reason businesses do engage in this practice of um, selling assets and then leasing it back. Um, you see this actually a lot with retail stores. Just as an example um, of like Kmart, which doesn't really even exist anymore. Um, Kmart, when it was dying in the early 2000s, one of kind of the last attempts of a person that tried to get in there and take some money out of the company, what they did is um, um, they formed a separate company that owned the real estate, and then they leased it back from that new company that owned the real estate, so that Kmart could then recognize the gain of having sold the asset to the other company. Okay, so it's immediately as an ordinary gain, and that's as long as everything else is consistent with ASC 606. Okay. Here, what we have here is a 5-year lease period with a $0 lease in first year, $10,000 in the second year, and then year 3 through year 5, $30,000 a year. Just getting out my little pen here. So, what that would mean we have here then is $10K from year 2, and then $90K from years 3 to 5. And essentially, what we're going to, if we're looking at how are we recognizing that operating expense, it's going to be the total lease payments divided by number of years. In this case, total lease payments is the summation of this, so it'd be 100K divided by 5 years. That gets us a 20K a year operating expense. So, correct option should be 20,000. Okay. Consistent with 842, lease contracts are classified in these categories. It's all of those, everything. All lease contracts are under ASC 842. So it's not just short-term operating or financing leases, it's all of them. This one, pretty definitional here. Yeah, sorry. So the correct option should be right there. Okay. Executory cost of a lease. How are we going to treat those? So, definitionally, any of the costs. So, what is an executory cost? It'd be the cost of like drawing up the lease, executing it. Those costs, those are operating expenses, right? Because the lease is part of your is one of your operating activities. So, since it's an operating activity, the expense of that would be an operational expense or an operating expense. Okay. Which of the following ratios increase with the lessee's capitalization of the lease? Well, that would mean you're borrowing money, so that would mean your financial leverage is increasing. So that's what, if we're capitalizing, if the lessee is capitalizing its lease, then that ratio that increases would be your financial leverage as you borrow to finance that lease. Over the lease term, the total income derived from a lease is blank if the lease is classified as a sales type lease instead of an operating lease. Those are the same. You're not going to really treat those any different. Let's just remind ourselves what each of those types of lease are, what each of those two types of leases represent. A operating lease, it basically again permits the use of the asset, but you don't own it. So use it for operational reasons. Then for a sales type lease, then what you're doing here um, is um, that lease would be one where the profit or loss is recognized when the lease is commenced. Um, and so for both of those, um, the income you get from each of those types of leases, um, it should be the same. There's nothing that, in terms of how the lessor is going to account for that, there should be no change. We shouldn't be particular to one lease over the other. So our correct answer would be here. That sales type leases and operating leases are the same in terms of how we recognize that total income derived from the lease. Okay. Ford is going to sign a non-cancelable 8-year equipment lease with Ray. The lease has an implicit rate of return of 10%, and that rate is known to Ford. The incremental borrowing rate is 8.5%. Ford has a 9% incremental borrowing rate, so we've got a difference there, slight difference in their incremental borrowing rates. Ray believes that the equipment has a 10-year service life, but somewhere between the 5th and the 7th year, you might have to do a major overhaul. Ray warrants the equipment for the full 8 years. How is Ray going to treat this lease? Well, that's all of the description of a sales type capital lease. So, in some sense, this is definitional of what a sales type capital lease is. Um, a uh, lease for the equipment that's sold to another party, that equipment that is leased to the other party depreciates over time. And if you are borrowing to finance that lease, um, that would bring into account our incremental borrowing rates. But in the description that we have here, that's all the hallmark features of what a short term lease is. Sales type capital lease is. It's not short term. Sorry, I don't know why I said that. It's not short term because the length of time is obviously greater than a short term lease. Okay. Bloom Corporation is going to lease its equipment for a 10-month time period. The entire related lease payment is due at the end of the 10-month period. Okay. So, what's that journal entry going to be? This is a short-term lease. This would be our definition of a short-term lease, less than a year. This would be a short-term lease expense. January 1st, lesser corporation enters into a lease, treated as a sales type lease. Um, okay, so you can read this. You don't need me to read to you, but let's get the pen out here. Okay. So we are trying to solve you're trying to solve for the increase in net income that is um, going to be our gross profit plus our accrued interest. Accrued interest being the interest earned um, for the time period here. What is gross profit? Gross profit would be my present value minus my book value. The present value, we are told, is 362 345, and our book value is 350. Okay, so that gets me 12,345. And then in terms of the accrued interest, that's going to be my that's going to be my 312,345. Now, why is it 312? That would be 362, 345, the present value minus the $50,000 interest payment that would have been made by the end of that year, right? Because I'm comparing January to December, so that would be 1 year. So I would have had one $50,000 payment. So I would take my present value of 362, 345, subtract 50, that gets me 312, 345. And I need to multiply that by the implicit rate of interest of 8%. Let's see here. $312,345. That would be 24,987.60. Adding these two together gets me 37,332.6, which rounded gets me that answer. Okay. Now we're asked what kind of lease this is. 10-year lease agreement, year-end annual payments of $160K. At the end of that time period, you're not getting to purchase the asset, the leased equipment, at any sort of discount, nor is it the title transfer upon completion of the lease period. Fair value was 1.1 million. It's going to last though 14 years, so it's going to last longer than the lease period. How is the lessee going to classify that lease? Well, that's all the features of a operating lease. Right? right? And now here the equipment is being used to produce the good. The asset itself is not a it's not a asset that's valuable because of the inherent value of the equipment. Rather, the value is derived from the fact that it can be used to produce the other goods that are needed. Okay. Clear manufacturing. Clear Manufacturing sold its plant for 1.2 million to Burt Company. Had a cost of 1.2 million, sold it for 1.4 million. So obviously, we're seeing that there's a $200,000 difference there, and then they're going to lease it back immediately thereafter for a 15-year term. How are we going to record that sale and lease back? Well, the Clear Corporation, which did the selling of the company, selling the plant to a different company and then immediately leasing it back, that's all features of a notes payable. In this case here, the revenue that's captured over time um, is all part of a short-term, short-term in terms of bond markets, but it's um, I guess it's kind of a medium-term um, um, piece of debt, which would be known as the note, which is then that note is then payable um, when you lease it back to yourself, basically. Okay, so now what if the lease has a residual value guarantee? So remember, the residual value guarantee basically states that upon the conclusion of the lease, that the leased item will have a minimum value. So how would the lessee, how would they treat that? So well, um, what we would do here, what would the lessee need to do? Well, we need to know what that guaranteed amount is, and we need to find out what the present value of that is. So, what we're going to do here is take all of the lease payments that would be made over the course of the entire lease, add to that the present value, to be more precise, the present value of that guaranteed amount plus all the lease payments. So let's see if we got, yeah, the very first one. So this is, again, something that's a bit more definitional, which again, I'm trying to focus on those kinds of things for the exam, or the definitional types of things. If we had this class in person, we would be doing much more problems. It's just a little bit more difficult to do the problems when we don't see each other we don't see each other in real time. When accounting for a long-term operating lease under 842, which of the following accounts are charged with the expense on the income statement? Um, well, that is a lease expense. A bit easy of a question here, but this is just the um, definition of what a lease expense is. Okay. Under 842 and IFRS 16, um, what's the assumption? So in this case here, sorry, um, uh, just seeing if I have any notes to myself for this. No, I don't see any. Okay, so really, this comes down to who owns it. Um, that assumption. So this would all lead back to our property rights definition, and that's what 842 and 16 guide us to do. Is this is a property rights assumption. Temporary and unilateral, you should have been able to cross those out immediately. Should have been stuck between the two. We know that the executory rights. That's not what's covered in here under 842 and 16. This is all about property rights. Film company. Film company is leasing an asset over its life of 6 years, and that payment is the present value of those lease payments is 240. Market value of the asset is 258. So obviously we got a difference there of 18K. What is the property rights approach? What is that asking us to do? Well, because we're dealing with something that's greater than 1 year, we're dealing with something here that's of 6 years. We do need to look at this in terms. The lessee needs to look at this in terms of the um, asset features and liability features of this lease. And so that's what we get here. So just by definition of these two standards for the property rights approach, it's because it exceeded it by 1 year that then the lessee is going to recognize this as a both an asset. There's asset features to this and liability features to this. Okay, so now this one is a kind of a short answer one. So basically, what are the questions that we would ask ourselves when we're trying to determine whether a lease is going to be treated as a finance lease or an operating lease? Well, I wrote down I have 5 questions here. Let's look at the 5 questions here as I wrote them out. Again, these might not be exactly the same as they are in the book, but this is what I know to be true. So the first question would be is, does the title of ownership transfer at the end of the lease? So basically, if you as the lessor, the one who's leasing this item, if you get the title of ownership at the end of that lease period. Um, well, if you do get it, then you've basically financed the purchase of the asset. Um, so if you answer yes to this, right, you've basically, it's kind of like rent to own. So that would be, so if yes, that's a finance lease, right? There's a difference. I mean, the best way to look at this would be, you know, um, when I rent my apartment, I get to use it for a month, right? And then I have to pay again, and I get to use it for another month. But when the lease ends at the end of the year, I don't own any small portion of the thing I'm renting. So that is a finance lease. If no, then it's an operating lease. 2. Is there a bargain purchase option? Same thing here. If there is that bargain purchase option, that option to purchase that is at a discounted price, basically, because you would engage in that lease transaction, then again, that would be a finance lease. Because basically, again, the benefit is coming from the fact, the discount is emerging from the fact that you had spent all this money for the lease. Is the lease term is the term of the lease, is it for most of the economic life of the asset? Um, if it is, that again is a finance lease, because basically you've indicated you don't have the money to buy this item outright. You're just going to basically provide the value equally over a period of time. Again, kind of like rent to own. So if yes, then that would as well be a finance lease. Okay, number 4. Does the present value of the lease payments, does that present value um, exceed the fair value? If you answered yes to this as well, this would be a finance lease. The nature of the finance lease is, in this case, that I'm gaining something that has a fair value. Um, um, am I gaining something that has a fair value that's less than the present value of the lease payment? So now the lease becomes almost a vehicle for saving cash. And then finally, is the asset very specialized? Um, if it is very specialized and you have to lease it out because of that, that would also be a finance lease, because basically it's kind of like a made to order asset. It was made for you to use it, and there's no one else that they can alternatively sell it to. So for that reason, again, if you say yes, that's the nature of a finance lease. those are the 5 I came up with from at least 842. I don't think there's really any others here beyond those. Okay. Flatiron Corporation. This one we do not need to do. I solved it, but then as I was looking over what is going to be in the exam, there's nothing like this here. So do not worry about this one. Everyone will get full points for that, even if you just leave it blank. Okay. Unequal lease payments, how are we going to treat those? So definitionally, even though the lease payments are unequal over that time period, for accounting purposes, we would just allocate those equally over the time period, um, just to kind of reflect the use of that asset over time and the costs that are attributed to that use, especially in terms of the as the operating lease, right? There would be presumably an output that we could capture with that lease payment. Okay, so we would allocate it equally. Fleming Company. The asset has a 6-year useful life. Present value of the lease payments is 240. Market value of the leased assets is 258. How are you going to recognize the inception of that lease? That's all the present value. So that's all the present value of the lease payments right here. And that's just definitional. It's my by paying that 240, I now have a right um, to use that asset for the 240 because of the lease agreement. It doesn't matter that the asset itself has a value of 258. Um, that has no influence in terms of my legal right to use that asset, because the lease is the thing that's providing me that right to use it. Okay, now we've got Mori Corporation here. Okay, so now we're going to lease a tractor from Equity Leasing, 5-year non-cancelable lease. So we've got 5 payments of 26,379.74 due at the end of each year. And payments are calculated based on the fair value. Lease is non-renewable. 6-year economic life versus the 5-year lease. Excellent credit rating and no warranty, meaning there's no legacy expenses here. Well, what we would see here, right? We do obviously want our debits to equal our credits. Let's see here. So in this case here, the 5 payments. No, sorry. They're as of January 1st. Sorry, that's why I was getting confused there. So what we're going to do here is we're going to have the basically we have a it's a right of use asset given the criteria that we have here. So we should already be able to cross out the first option because this is not a rent expense. This is a right of use asset. So now the question is um, what is the value of that right to use asset? Um, let's see here. So okay, so um, what we have here is the. Sorry, my calculation is off here. Let me pause this here. It's just taking a while. Let me pause this for a second. Um, okay, sorry about that. Um, so the what we need to do here is we've got 5 payments of 26,379, and then we have a 9% implicit rate, which requires us then to have the present value table as well. I wish the book would just give us a pop-up of that rather than us always having to open up a new window. But when you see the implicit rate here of our 9%, again, I just type in a search term of the present value table. This is a 5 year, so 5 period lease at 9%. So I then summed up those 5 numbers. What I got was 3.889 when I summed those up. So you're going to want the present value table available to yourself when you're taking the exam. 3.889 times the 26,379.74 times 26,379.74 gets me 102,590. Okay, well, I think the problem here, it's unfortunate. The problem here is that my present value table I just called up here just has 3 significant digits. The book must have used a present value table that was a little bit, um, took it out a lot longer in terms of decimal places. So I got 102,590 using 3.889. That's the closest we can get here is 102,607. So that must be the right answer for what they have. Now the debits equals the credit. So here my finance lease liability is going to equal my right of use of asset. And then finally, under ASC 842 over the life of the lease, what the amount that's going to be charged to expense. This is definitional. It under 842, it doesn't matter whether it's a finance lease or an operating lease. It's going to be the same in terms of what's being charged as an expense. So here, the answer is here, and that's just definitional. Okay, I hope that helps you understand the homework assignments a little bit better, and helps you as well prepare for the exam.